I chose the stock of the day today as James Hardie, the big building materials group multinational. This morning, raising its full-year profit guidance, counting on the ongoing housing boom in the US to keep growing. Now sees full-year income between 550 and 590 million US dollars. Company also giving capex guidance of between 250 and 350 million in US dollars over the next 3 years. This is, as it reports, a 50% surge in first quarter earnings, with first half earnings, with sales jumping as shortage of materials and labour pushed up prices, boosting margins. Despite the bumper result, the board has flagged there will be no dividend reinvestment plan in operation for fiscal 2021. Howard, what do you think of the James Hardie result and also the stock?
Yeah, it was a fantastic result. I mean, there's clearly a building boom going on in terms of prices as well as in terms of volume. And there's nothing that's better for any business than an ability to increase prices because there's a shortage of what you're selling. And we're seeing that with some of the companies in our tip group at the moment as well, where they're able to raise prices because there's a shortage and people badly want their products. So a marvellous result. Their guidance for the year is about double the profits of the previous year. They've had one quarter of the new year, which is excellent. But it is on a particularly high PE ratio at the moment. So return on equity looks good. Their debt levels are a bit higher than we require to count a company as a potential wealth winner, but it is coming down. The last 3 years in a row, their debt levels have come down, now only slightly above our filters, so they may pass at the end of this financial year. And earnings are growing. The only thing, as I say, is PE is high, and the time to buy a cyclical stock, one connected to the housing industry like this, is when the cycle's down, when everybody's talking about doom and gloom in housing construction, and the reverse is happening now, particularly in the US where it's going gangbusters. So I would say great company, looks good, price a bit too high, wait for bad news in the building industry, and that's the time to be buying it. Okay. This time last year was a better time.
Sure. Gary?
Yeah, no, I'm probably similar to Howard there, actually. I think, yeah, I mean, obviously great result there. I mean, the sector's on fire at the moment, which is positive for the whole group. Obviously, Brickworks reported yesterday, even though they sort of suggested that brick sales were off 50% since the lockdown, but the EBIT was up 35% for the year, which is sort of cracking for the sector. So I think you'll see most of the stocks across the sector will be pretty robust. I'm long a few Adbury. It's probably one of my larger holdings there, so it's good for that sector, good for that stock as well. But Howard's right, just getting a bit pricey here. Look, the plus there, I think it's funny that the brokers have actually got this one right here. I think there were sort of 7 strong buys, two moderate buys, 2 holds, and 2 strong sells. So in this case, most brokers were pretty bullish the sector, which is positive. It is expected to grow earnings next year, which is sort of what most companies have sort of, most analysts are probably looking for a tapering off, whereas James Hardie, just because of that US growth there, expecting it to be a stronger year next year as well. So that's probably the plus there. So it probably goes a little higher here, but it is pretty pricey. Stock will probably just grind slightly higher. Okay,
so if you've held it and you bought it even 6 months ago, and you bought around $30, if you look at the one year chart, would you? Is this the peak of the market? Would you sell at these levels, or do you hold if you're an existing shareholder, Gary?
You're getting close there. I actually did square a few ranges out in the stock there. I noticed at $52.50 and $54, a couple of big sort of technical levels where they might be able to get to on this run here, but. Yeah, it depends on your style. Yeah, for me personally, if I'm probably slightly more active than Howard. So if it got up a little bit higher, there up towards $52.50, maybe $54, then yeah, I might look to lighten off sort of some of those or all of those. You know, okay. Oftentimes you might lighten off some of those and look to buy them back when they pull back.
Right, Howard.
No, we wouldn't. I mean, I always liken it to, seeing as we're all AFL supporters here, I can talk about it. I always liken it as saying if you've had a player who's just had a dozen fantastic games in a row, terrific number of possessions, lots of tackles, great accuracy of all their passes, and you decide, oh, well, he's obviously past his best. I'll get rid of him and get somebody else who isn't doing as well. Companies are run by people. And if people perform exceptionally well, it's a good predictor that they're likely to perform exceptionally well in the future. Now, obviously, in footy, eventually you get old and you can't perform, but that doesn't really apply that quickly in business. So all the evidence shows that people who hold on to genuine winners. Now, when I say winners, I don't mean the share price is going up. I mean the share price is going up because the earnings are going up, do better in the long term than people who chop and change. And perhaps the reason is if you bought it, say, 30 and you sell it, say, 50, the next time the share price drops to 40, you're disinclined to buy because you say, last time I bought it at 30, and you're waiting for it to get to 30 again, which of course it doesn't do because the earnings have gone up. So you tend to do better by sticking with the companies you know really, really well and adding to them every time their share price gets cheap.
Yep. Okay. Good advice from both of you there.